That's kind of fascinating.
It is, and it's what allows for things like policy assignments, where the ownership of the policy can change hands down the road.
Okay, so like if a business takes out a policy on a key employee and that employee leaves, they could potentially transfer the ownership of the policy. Okay, that makes sense. So how much insurable interest is enough? Like, are there limits on how much coverage you can get on someone else?
This gets a little fuzzy because, unlike property insurance, where the idea is you're only compensated for your actual loss, you can't really put a price tag on a human life, right?
Yeah, exactly. It's way more complex.
Generally, the amount of coverage has to be reasonable, justifiable based on the potential financial loss. So the insurer is going to look at things like income, debts, future needs, things like that.
Right. So like a stay-at-home parent versus a CEO, the coverage amounts might be vastly different.
Exactly. And of course, the policy owner has to be able to afford the premiums, and the insurer has to be willing to issue that much coverage. One interesting point is that an individual is considered to have an unlimited insurable interest in their own life.
Okay. Yeah, that makes sense.
There might be some practical limits, though, especially when you're talking about insuring children. Often, the amount of coverage they can get is tied to how much insurance the parents have on their own lives.
Oh, I see. That makes sense. So we've tackled insurable interest. Who needs it? Why it matters.
Hmm.
Now let's move on to that second big question.